in tonight's class, I'm going to use the term security. I might also say Facebook, I might say Google, I might say the euro, or I might say Bitcoin. But I'm not talking about a particular share or asset. I'm talking tonight about all publicly traded financial assets, instruments in which there's an open market. I also intermix the terms investing and trading. Now, since we're all here part of ETX, we are traders. Traders take a short-term position in which to make profit on short-term market moves, where we know the difference. We know what investing is, but I mix up the terms only because it gets boring just saying trading, trading, trading. Now, one of the first questions I'm asked, whether I'm giving a webinar or seminar, whether I'm at a conference, whether I'm meeting traders one-on-one or in a group somewhere, the first question everybody asks, what should I buy? What should I sell? What will the prices be today? What do you think Bitcoin will be later today? Will Bitcoin give back from its 8,000 gain? Will the euro soar back over 115? Now, wouldn't investing or trading be easy if we knew the answers to these seemingly simple questions? But alas, I don't have a crystal ball and I don't have a Ouija board, and anybody who tells you they can tell you these things is full of it. Period. The end. Nobody can tell you where an asset will be, what it's going to do. Okay? They can use analysis to figure out what it might do or where you might get some indication, but nobody knows what the price of an asset is going to be an hour from now or 3 hours from now, because it's all about human beings trading in the market. So if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. However, if you're attending this webinar with the hope that technical analysis will improve your investing and trading, I got good news for you, that it will do. Now, the term technical analysis sounds complicated. It's almost scary. It almost sounds like it's too much work. Got to go back to university. But simply put, technical analysis is the study of price movement or prices, with charts being the primary tool. And in the most simplest terms, and basically I don't ever use the word technical analysis. I call it chart analysis or price analysis. Anything and everything you do on a price chart, whether you're just simply reading the chart, whether you're looking at a line chart, whether you're putting a circle around the price, is technical analysis. Now, the roots of modern day technical analysis stem from the Dow theory, which was developed by Charles Dow. And we know who Charles Dow is. We know all about the Dow Jones. Now, stemming either directly or indirectly from Dow theory, these roots include such principles as the trending nature of prices. Prices discount all known information, confirmation, and divergence, volume, mirroring changes in price, and support and resistance. And of course, the widely followed Dow Jones Industrial Average is a direct offspring of Dow theory. Charles Dow's contribution to modern day technical analysis cannot be understated. His focus on the basics of a security price movement give rise to a completely new method of analyzing the markets. Now, many of us know things about retracement levels and things like Fibonacci levels, but all of that includes a 50% retracement level. But you know what? It's got nothing to do with Fibonacci. It's got nothing to do with retracements. It all comes from Charles Dow. He's the one who observed that when an asset moves in a particular direction, when it reverses, it will most likely move to about 50% of its prior gain. So he was the first one to actually study prices as opposed to the fundamentals that affect a asset's price. Now, you can remember when he was doing this, we didn't have computers. We didn't have the internet. Now, remember, the price of a security represents a consensus. It is the price at which one person agrees to buy and another agrees to sell. The price at which an investor is willing to buy or sell depends primarily on his expectations. If he expects the security's price to rise, he will buy it. If he expects the security's price to fall, he's going to sell it. Remember, the market is all about human beings. These simple statements are the major cause a major challenge in forecasting asset prices because they refer to human expectations. As we all know firsthand, humans are not easily quantifiable or predictable. This fact alone will keep any mechanical trading system from working consistently. If we really believe that robots could interpret all the price movement in the market and make good trades, none of us would have to trade. We would just get robots. And all the robots would eventually be programmed the same and the markets would do exactly the same. But the markets all are based on price action. And price action is all based on human beings. So because humans are involved, I am sure that much of the world's investment decisions are based on irrelevant data. Our relationship with our family, our neighbors, our employers, the traffic, our income, our previous success and failures all influence our confidence, expectation, and decisions. Now you think wow, that's crazy. You go look at this big price chart and you see, Google's trading at this and it traded a couple 100 million shares today, and it's being traded by hedge funds and banks and big investment companies, and you're saying human interaction, human element. Well, just think if you were a trader for a big bank, you're trading a billion-dollar fund, and this morning when you're leaving the house, you ended up having a tiff with the wife. So you're in a bad mood. You get in the car and traffic's even worse than expected. You're even in a worse mood. Then you end up getting a flat tire. So you get out to fix the flat tire, the rain comes down. Now you're in a worse mood. You arrive at your office at 7:30 in the morning, ready to grab your cup of coffee and do your daily prep before you start doing all your major trading for the day. And guess what? You're in a bad mood. There's no coffee in the coffee pot. There's no cream in the refrigerator, and you're pissed off already. Well, guess what? That normal day, they would have gone along with the sunny day and the easy ride to work and a kiss from the wife, and you would have been at your desk, computer pumped up, and you would have been getting ready, and you would have been buying, $2 million worth of Google because you saw, you thought the Google was going to go up. Didn't get made, only because all of these irrelevant things happen. Now, this guy can't manipulate the markets. Okay, market's too big to be manipulated by a person. But when a group of people, look what happened when Donald Trump this week killed that general. The markets went haywire. This is human interaction. This is people running off into safe havens. Now, if prices are based on investors' expectations, then knowing what a security should sell for, which comes from fundamental analysis, becomes less important than knowing what other investors expected to sell for. That's not to say that knowing what a security should sell for isn't important, but there is usually a fairly strong consensus of a stock's future earnings that an average investor cannot disprove. So in my experience, only a minority of technicians can consistently and accurately determine future prices. However, even if you're unable to accurately forecast price, technical analysis can be used to consistently reduce your risk and improve your profits. Now, before we talk any more about improving your profits and reducing your risk with technical analysis, even if you wanted to be a fundamental trader, you wanted to trade some news and headlines, prices and earnings. Okay. If I were to say to you, Google's trading at 162, was at 159 early this morning, and went to 157, then went back up to 161, then fell back to 154, then went up to 167 and went back to 162, and now it's trading at 164.5. Could you repeat any of that to me? Could you make any sense out of what I just said? Do you see a trend line? Do you see support and resistance? Do you see any commonality? No, because your brain can't absorb that, can't put it into any picture inside your head. But if you saw those same numbers on a price chart, you could instantly see if the price was trending up or down. You could see some common prices that are hitting often. And if I were to read all the newspaper articles, I was reading all the news, I was going to go deep into Google's earnings structure and all the stuff that's going on in their quarterly reports. Okay. I might decide that Google should be going up over the long term or over the next couple months. But none of that's going to help me figure out if I should enter the market at 162 or 161.5. And because we're short-term traders, we're looking for when to enter the market, make profit, and get out of the market. The fact that Google is going to go to 172 or have a 20% increase this year because all the numbers point that way is important to an investor, but it's not as important to a trader or a short-term person looking to make profit. So keep that in mind. So the best analogy I can find on how technical analysis can improve your investing is a roulette wheel. And I absolutely hate mentioning gambling or gaming in the same breath I do trading and investing, because it's got nothing to do with one another, basically. So the analogy with reservations is gamblers have very little control when compared to investors. Although considering the action of many investors, gambling may be a very appropriate analogy. But let's not talk about the gambler side. Okay? Forget the gambler. We're a casino. Now, a casino doesn't want to gamble. A casino wants to make profit. And technically, a casino doesn't really care whether you win or lose at the table. They don't care if somebody has a winning streak over here and a losing streak over there. They want to know consistently they're going to make 2% on every pot, or they're going to make 4%, no matter whether there's dollars traded up or dollars traded going down. They don't care. Okay? You as a trader really don't care whether Google's going to go up or Google's going to go down, just as long as you make your money. You just want to be on the right side of the position. You want to move the odds of making successful trades in your favor. So a casino makes money on a roulette wheel, not by knowing what number will come up next, but by simply improving their odds with the addition of the 0 and the double 0. Do you know that's why the 0 and double 0 on the wheel? It moves the odds into the favor of the house. It gives them their percentage of constant winnings. Similarly, when an investor purchases a security, he doesn't know that its price will rise. But if he buys a stock when it's in a rising trend, after a minor sell-off, and when interest rates are falling, he will improve his odds of making a profit. That's not gambling, that's intelligence. Yet many investors buy securities or assets without attempting to control the odds and move them in their favor. So contrary to popular belief, you do not need to know what a security's price will be in the future to make money. Your goal should simply be to improve the odds of making profitable trades. Okay? I don't really care if Google's going to be at 172 in 3 months from now or 152 in 3 months from now. I could care less. I could care less whether Google's going to be profitable. Now, my retirement portfolios are different, but as a trader, all I want to do is be on the right side of the trade today. So even if your analysis is as simple as determining the long, intermediate, and short-term trends of a security, you will have gained an edge that you would not have without technical analysis. Now, if we accept the fact that human emotions and expectations play a role in security pricing, we should also admit that our emotions play a role in our decision making. Many investors try to remove their emotions from their investing by using computers to make decisions for them. Remember in the movie 2001 Space Odyssey, the computer HAL, that tried to make every intelligent decision. Well, mechanical trading systems can help us remove our emotion from our decisions. Computer testing is also useful to determine what has happened historically under various conditions and to help us optimize our trading. Yet, since we are analyzing a less than logical subject, we must be careful that our mechanical systems don't mislead us into thinking that we are analyzing a logical entity. And this is what's very important. You have to understand that no matter how much you learn, how much technical analysis, mathematical formulas, and everything else you want to put to it, ultimately it's price action, because price action is controlled by human emotion. So when you want to say that when RSI is over 80 and MACD does this, we're going to do that, it doesn't work. These are only pieces of information. And most technical analysis should be thought of as a secondary confirmation system and not as your primary role decision-making capability. It's some of the filters. Now, technical analysis is based almost entirely on the analysis of price and volume. The fields which define a security's price and volume, are open, high, low, and close. Now, when you think about it, whether you're using RSI or you're using a moving average or you're using Bollinger Bands, they all are based on, excuse me, the same 5 numbers. The open of the asset, the close of the asset, the high of the asset, the low of the asset, or the volume. All of these mathematical equations that are put onto charts and put on the graphs and calculated are all based on the same pieces of information. And these are historical pieces of information. The open at 1 o'clock today was the open, no matter where you look at it, that was the open. The close at 2 o'clock today was the close at 2 o'clock. The high in this 1 hour segment is the high for everybody everywhere. So technical analysis involves looking at patterns in price history to determine which higher probability time and place to enter and exit a trade. As a result, technical analysis is one of the most widely used types of analysis. Since online trading in most cases involves only major assets, the movement on charts from the prices action generally gives us clues about hidden levels of supply and demand. So technical analysis is a bit of a misnomer since it's really not that technical. A better name for the use of charts to make investment decisions might be risk-reward analysis or even market psychology. And I know it's very, very difficult for any trader, even myself, to realize when I'm looking at the price of Bitcoin at $8,000 and I'm looking on my moving average and I'm looking at RSI and I'm looking at stochastics and I'm looking at my support and resistance to say, okay, I can do all that, but it's all affected by all of these people around the world that are being affected by personal emotions. That's what it is. It is the market psychology. Sure, there are some complex mathematical concepts involved with some of its more esoteric indicators, but at its pure technical analysis is simply a method of determining if an asset is worth buying or selling. Once we identify this, we are way ahead of the game with regards to assembling a winning portfolio. So simply stated, it's generated from the markets and from the action of people in the markets. Such data includes price levels that have served as turning points in the past, the amount of stock or assets contracts being executed, which is volume, and the rate of change of price movements, momentum. Okay, so let's take a look at some charts. Okay, this is my Euro US dollar standard teaching chart. As soon as it pops up on your screen here. There we go. Okay. Now I put on here tonight for a couple technical indicators. On the bottom we have MACD. Now tonight we're not going to go into these explanations indicators. I'm going to show you a little bit about them later, but we have whole classes on MACD. It takes me an hour class just to explain to you MACD. But it's moving average convergence and divergence. It's a technical indicator that's put on the bottom of our charts. Then we have, on our charts, I have two moving averages, a simple moving average and an exponential moving average. These are indicators that are placed on price action. They are all technical indicators. Okay. Then we also have things like Bollinger Bands, okay, which is placed on price charts. It's an indicator. Now there's all types of fields. Now we have a whole class on just what we call technical indicators, because technical indicators is only one small bit of technical analysis. Okay. These are mathematical calculations that are placed on the chart below or above, and they are a graphic that we interpret. And these are known as indicators. Indicators should be your last or your secondary decision-making tools. Ultimately, it's price action that determines everything. Then volume. Then what we call support and resistance levels. Now, support and resistance levels are quite important. Okay. Support and resistance levels. See all these lines that are coming through that I've drawn on here, the yellow, the gold, and the red? These are what we call support and resistance level. Now, these I drew on here a long time ago. Okay. Because these are price levels in the past. US dollar has had a problem moving above or below, where a rally and up got stuck, or a trend falling down bounced off of. Prices where the asset spent a lot of time. And these are drawn from historic prices forward. And really, they tell us how the market or the people making up the market reacted to a particular price as price moved up there. And you can see these lines as they're projected into the future. Now the help us when price is in that area. So you have lines way above and way below, but we only need to be concerned with these levels at where price is. So you can see, look, currently today, look at all the reaction to this gold line. Okay, look at how price stayed right below this gold line here and touched it and touched it. When it rallied up, it just broke through that and went right back into it. Now, this is a historic line that I brought forward from months and months and months ago. In fact, over 6 months ago, because my lines are color coded and the gold lines are over 6 months and the red lines are a year ago. So down below, you see these red lines. These are levels of support and resistance or price levels where the price has had a problem in that. But I don't need to be concerned with these right now because price isn't falling down this level. But when they come down to here or when price starts to decline, I will look at these levels again. But the reason I'm telling you this is these are other types of what we call support, what we call technical analysis. We refer to these as support and resistance, but it is also done on a chart. So it is therefore in the field of technical analysis. Then we can move over, and here we can see a Bitcoin chart. And here we have something completely different. The yellow areas are support and resistance zones. And what we see here is what we call a chart pattern, where the price has actually developed into a triangle. Okay. Chart patterns are one of the major ways that we look and determine price. And as we can see, as this triangle has developed, price would eventually, as it moved into the apex, do what we call a breakout. When price broke out, okay, we could have confirmed that breakout and we could have then traded in the direction of the breakout. Okay. This is, like I said, called a chart pattern. Okay, again, you can see it here. Okay, but these all fall into the study of technical analysis. Now, down below here, you can also see volume. Okay, volume is a confirmation tool. It's technical analysis, plus the volume of contracts or assets being bought and sold at any time. We need that as a confirmation because we think an asset's can go up, but we see volume falling. That means traders are not coming in the market or leaving the market. We're not sure that the market's made any decision. Okay. Then, of course, we have the very famous trend lines. Okay, trend lines. Let me just get some of this stuff off this chart here. Trend lines are lines that we put on the chart that support a particular price movement in a particular direction. And they're rule-based, and they're drawn on a chart to help us see where price should be supported as it moves down and determine whether price is moving in an uptrend or a downtrend. All of these fall into the study of technical analysis. Now, let me go back to my, hold on a second. So technical analysis also attempts to measure the collective investor psyche, heavily on the psychology of crowds and the cycle of greed and fear. If everyone thinks one way, the odds that the market thinks the other is usually high. Was investor sentiment ever as negative as it was in March 2009 when the market put in the very, very important bottom? Critics will point out that forecasting future price movements based on past price movements is akin to reading tea leaves or divining the future from the texture of chicken entrails. Many of the high priests of fundamental analysis are quick to call technical analysis the financial world's alchemy. Indeed, chart watchers cannot predict the future any better than your broker, your spouse, or a Ouija board. But what technical analysis and charts do is help you make better decisions. They will help you find the right point in which to enter the market. They will help you determine where to put your stop loss. So if the market starts moving against you, something has to tell you what the average swing of a price is. The price doesn't move this way. Price moves this. In fact, a very good trend is a set of pushes and eases and pushes and eases. Well, if you're going to trade something to go up, you need to be able to determine when it eases back down, is it going down or is it just making the standard push and ease that we find in a proper uptrend? Well, this is done through technical analysis and on charts. The only place that you can get this. Okay. When the market starts turning against you, you're not going to see that in just the little prices coming across the ticker tape. You're going to see that on a chart. So what they can do better than most is make a decision about what to do. Buy, sell, or hold based on the probabilities of actions of other given traders, other given conditions. In other words, if a pattern on a chart appears, a chart watcher can create a framework for what the market might do if and when the price breaks free. It does not work every time, but past performance does give us an idea of what will happen so that we can do something about it. Now, statistically, you will have more losing trades than you will successful trades. The idea is technical analysis will help you get out of those losing trades with small losses. So your profitable trades will cover your small losses and make you profit. And you cannot get this in any other way. You can't get this from fundamental analysis, quantitative analysis, from analyzing a stock's profits and earnings. So the foundation of technical analysis is the chart. In this case, a picture is truly worth 1,000 words. Prices can be displayed as line charts, which are very simplistic, or as complex as a bar chart or a candlestick chart. But all of those are based on the same price, the high, the low, the open, and the close. So technical analysis is the study of historical price action in order to identify patterns and determine probabilities of future movement in the market through the use of technical studies, indicators, and other analysis tools. Technical analysis boils down to two things: identifying a trend and identifying support and resistance through the use of price charts and time frames. Now, if you were to believe the same way I believe, that price is random, because of human nature, price is random. But there are certain times that price becomes non-random. And these non-random times of price movement are called trends. And when a price is trending, when a group of millions of traders around the world start buying an asset and pushing that price up, it takes a lot of energy to stop it. So that's when it moves in a trend. In that period, the price is non-random. When the price is non-random, you can apply some very good analysis that will hold true. Because most of the time, the markets are completely random. Then when you can identify the levels above and below the price, that the price might stop and falter at. Doesn't mean it won't continue up or down, but it might stop and hem and haw. That help you interpret what the traders or what the market psychology is at the moment. You can then use this to make decisions, because markets can only do three things. They can move up, they can move down, or they can move sideways. Price typically moves in zigzag fashions, and as a result, price action has only two states: ranges, when price is zigzagging sideways and all over the place, or trends. So technical analysis of the market can help you determine not only when and where to enter a market, but much more importantly, when and where to get out of a market. Technical analysis is based on the theory that the markets are chaotic, but at the same time, price action is not completely random. In other words, mathematical chaos theory proves that within a state of chaos, there are identifiable patterns that tend to repeat. This type of chaotic behavior is observed in nature in the form of, say, weather forecasts. For example, most traders will admit that there are no certainties when it comes to predicting exact price movement. As a result, successful trading is not about being right or wrong. It's all about determining probabilities and taking trades when the odds are in your favor. Part of determining probability involves forecasting market direction and when and where to enter into a position, but equally important is determining your risk to reward ratio. So how can you use technical analysis? Now remember, there is no magical combination of technical indicators that will unlock some sort of secret trading strategy. The secret of successful trading is good management, risk management, discipline, and the ability to control your emotions. Anyone can guess right and win every once in a while, but without risk management, it's virtually impossible to remain profitable over time. Since chart watching is not infallible, and even more importantly, it will tell us very quickly if our assessment of the market move is incorrect. For example, prices move higher from a triangle pattern in the chart and then fall back within that pattern, we know that we were incorrect in our original decision to buy. Either we missed something on the chart or the market simply changed its mind. We sell immediately and book our small loss, leaving our egos at the door. So basic chart analysis, rather. So let's basic yet powerful tools so you can perform some of your own technical tests on a security in which you might be interested. While professional technical analysts have dozens, if not hundreds, of tools at their disposal, it boils down to three steps. The security is currently trading, figuring out how it got there, and determining the power of the trend, and making a comparison of the assets to his peers in the industry and even to his own history. Today was a perfect example of that. Okay. Now, this morning, Bitcoin surged to over $8,000, highest it's been in quite some time. Gold broke 1560, the highest it's been in a very long time. But Ripple also soared, so did Ethereum. And why? The whole market moved to safe haven. Traders were moving out of currencies, and very unusual that the Japanese yen usually soars because it's a safe haven, and the US dollars are, but because the US dollar is a mess because nobody knows exactly what's going to happen with the markets and Donald Trump and this mess that he's created. The US dollar didn't gain, gold gained as a safe haven. And the traders moved to the crypto market for some reason, and every crypto soared. So it wasn't one asset, it was a comparison of all the assets in a market class. So when you can see all the assets in a market class climbing upward, it tells you that there's something overall in the market. So we want to be able to look at trends and trend lines as support and resistance. To do this, all there needs to do are these key technical tools. Then take maybe moving average and volume and momentum. To do all this, we just need some basic rules and a step-by-step process. So it's not all that complicated, but you need to know where to start. So look at the trend. We want to find a rising trend or one that is just starting to rise. Find nearby support and resistance levels. We're trying to find assets where demand exceeds supply and new supply is not likely to develop soon. So when we see a market trending, like I said, when we see a market trending, we know it's going to move into some non-random price movement. We can put support and resistance levels above and below the price by going back to historical prices, which prices around this area that's trading now were very important, or levels that traders couldn't get above. Like for instance, we know gold at 1500 was a very difficult level to break through. Gold has been trying to break 1500 for a long time, couldn't do it. But once it got, every time again, 1480, 1485, 14, it would hit close to 1500, fall back down. Yesterday, it soared right through. That told us something about the markets. Now, next week, when gold's back down to $1,100 or $1,200, those price levels are unimportant. They're only important when gold is trading near those price levels. Determine if the current trend is healthy. We want a price to be above a relevant moving average, but not so far that the asset is prone to snap back and decline. Check volume and momentum indicators to be sure that they are not fading as price is rising. We want to see volume going up as price is rising or falling. And we want to see that a momentum indicator showing that the market has the momentum to keep carrying in that way. If the asset passes all these tests, we have a candidate for a trade, because all of this is a filter system. So think about technical analysis. Don't be scared of it, but think about what we said. It is not about necessarily indicators. I don't use technical indicators for anything. I use price patterns and support and resistance. They're not indicators. They're not mathematical calculation. I personally believe everything I do, I draw on charts. And I look at price action, support and resistance, and trend lines and volume. Okay. Other people look at a combination of indicators. To me, indications are interpreters. Okay. When the market isn't speaking to you and the chart patterns and things on a chart aren't talking to you, indicators can help you figure out what they're saying. Or once I've got all of my decision based on my trading method, I can use indicators to confirm as a confirmation tool. But don't get yourself so wrapped up in all of these interpretations of things like RSI and MACD and stochastics and Bollinger Bands. You know, they're for later down the road, and you can spend months mastering one of them. Support, resistance, volume, trend lines, chart patterns. Before you know it, you get easy to follow trading system, because remember, all you're trying to do is pick up high probability trades and make sure that you have entry and exit points, and when the market moves against you, you know that it is, so you can get out of that trade. So thank you very much for joining us tonight. Thank you for being part of ETX, and we'll talk to you again soon. Remember, we have all kinds of classes on technical indicators, and then we have all kinds of classes on individual technical indicators. We have a class on MACD, a class on stochastic, a class on RSI. We have a class on moving average. We have a class just on displayed moving averages. So we have classes in all of these to break them down for you. But don't let technical analysis scare you. Think of it as chart analysis or chart watching, and get comfortable with it. So thank you very much, and have a great trading week. Bye now.